Hey, everybody, this is Brian Kapple, your Athens, Ohio Realtor. I am here with your breaking news for today, and that is interest rates and why are they so high? So, I'm getting a lot of questions from home buyers. They thought interest rates were going to start coming down or the mortgage rates, interest, all same thing, coming down with the Fed in 2024 cutting the interest rates down a full percentage point, but they're still not dropping down. So what's going on? Well, I went to Google for the answer. I'm at marketbusinessnews.com. Why are U.S. mortgage rates rising despite Fed rate cuts? So let's get into this. Mortgage rates follow bonds, not Fed rates. That's the problem right there. The mortgage rates, they don't even know who the Fed rates are. They don't know who the short-term interest rates are. That's what the Federal Reserve is controlling. Has nothing to do with mortgage rates. So what is the influence then? Treasury notes are the influence. Mortgage rates are largely influenced by the yields on 10-year U.S. Treasury notes or bonds, right? So what are these things? Treasury notes are a type of government bond which the U.S. uses to borrow money from investors, ding ding, like us, mutual fund investors, foreign investors, whatever. In return, the government commits to repaying the loan amount along with interest over a set period. A treasury yield often reflects what investors anticipate for inflation, economic growth, and monetary policy. So when these yields increase, mortgage rates usually go up as well. So for example, in December, the 30-year fixed-year mortgage rate jumped to 6.72% compared to 6.6% just a week earlier, right? Even though the Federal Reserve had recently cut rates. This was right after that. So the rise was tied to changes in the bond market driven by higher inflation expectations and growing uncertainty about the economy. So why exactly is the bond market so scared and nervous? Okay, there's several factors contributing to this volatility in the bond market. Number one, the big thing that's been hanging around forever that starts with a capital I, concerns about inflation. The U.S. annual inflation rate is currently 2.75% compared to 2.6% last month and 3.14% last year. Although it's moving in the right direction, it is still above the Federal Reserve's target of 2%. Most central banks globally aim for 2% annual inflation. That's their safety zone. Many investors worry that it will be difficult to bring inflation under fully control, particularly since the economy continues to grow at a strong pace. It's crazy, isn't it? Because it just seems like all of this is push-pull and nothing's working together. Physical and economics policies, government policies such as tariffs, tax cuts, tighter immigration rules can push the inflation rate northward too. So at the same time, raising federal debt and growing budget deficits have made investors increasingly cautious, which has placed upward pressure on bond yields. Also, uncertainty about the Fed's next steps. So the Fed Reserve Chair Jerome Powell has recently stated that there will likely be fewer rate cuts than expected in 2025. That statement has unsettled the market. So why mortgage rates are higher than treasury yields? Mortgage rates tend to follow the same direction as treasury yields, but they come with an added spread, right? Because they need to account for higher levels of risk. This is because mortgages carry more risk compared to government bonds for several reasons. Number one, default risk, right? Homeowners may miss payments or default, making mortgages less secure than U.S. Treasury bonds. So, I'm starting to see a little bit that's not a huge uptick in it, but certainly the inflation and the cost of goods going up puts a squeeze on a lot of people. Prepayment risk. You never would have thought that a prepayment risk would have an influence on where interest rates are at, but here's why. Homeowners can refinance or pay off their loans early, which may disrupt the expected cash flow for investors. So when mortgage rates are high, these risks are more pronounced. To compensate for this, investors require high returns, which has widened the gap between treasury yields and mortgage rates. So what are the challenges for home buyers? We know what that is, right? Many Americans want to buy their first home, may be unable to do so now because of the rising mortgage rates. When the mortgage rates go up, so do your monthly installments and your payments, right? So what's this say for long term? I don't know. Maybe once we get past the presidential transition period next week, maybe some of the rough waters will smooth out a little bit, and it will take some of that uncertainty out as far as those immigration rules, any tariffs and anything like that. So anyway, listen, this is Brian Kapple. I'm your Athens, Ohio realtor. If you have any questions or comments, give me a call. Make sure you like and subscribe to my video. That would make me feel pretty good about myself. Other than that, thank you for watching very much. I hope everybody has a great, safe, blessed day. Thank you.